In fact, Rahul Jain, who's the co-head of Asia Financials and head of India Research, Global Investment Research at Goldman Sachs, is with us to talk more about that. Rahul, thanks a lot for joining us. I know the run-up has been pretty sharp, right? In many of these banks, especially the PSU banks like SBI. Is that your biggest concern, the lack of valuation upside? And take us through what the rationale is over the next 12 to 18 months, specifically for PSUs.
Thank you, Sonia, and great to be on your show. I think a couple of factors that we have laid out in our report, three areas where we think the earnings are going to be facing the headwinds. Number one is, of course, the funding environment. Deposit growth is facing challenges from multiple quarters, and that's going to put upward pressure on the cost of funds. You've already seen the funding cost take a U-turn over the last couple of months. And given the fact that the rise of alternatives is giving a challenge to deposit growth, and the loan-to-deposit ratio is elevated, the banks will need to keep increasing the deposit cost over the coming quarters. Number one. Number two, if you see the credit cost, it has been a very strong and benign environment over the last many quarters. We think that that's kind of starting to bottom out. And the area where we are concerned about the most is unsecured loans. We have been writing about this to our investors that this space is overheating. RBI also took some steps around it, and we believe that this area is going to perhaps put some upward pressure on the credit cost. These two areas definitely is going to put pressure on the ROAs for the entire system. Private banks in particular had a phenomenal run over the last couple of years where the ROAs expanded significantly. We feel that now we are peaking out in terms of the ROAs, and from here, either the consolidation or moderation is going to happen. Right. On the PSU side, to your question about it, our investor interaction suggests that the most comfortable area for the investor is the liquidity position, the loan-to-deposit ratio, etc., compared to the private banks. But given the fact that we have seen deposit rates go up even for them, it implies that the margin benefit may not be that significant. And historically, the experience on the margin management from the SOEs have been rather mixed. So we believe that the upside is limited. The stock is fairly well priced or reflecting the potential areas of excitement that investors may be having.
Right. Rahul, hi, good morning. Prashant here. The second reason that you mentioned, for I think on the private side, which you said, rise of alternatives. Do you mean money not going into bank deposits, but into things like equities, etc.? Is that what you mean?
Yes, not only equities, Prashant, but also even the government savings schemes, if you see, is having a good growth over the last couple of years. So there's a pressure building up all along.
Got it.
I would also like to quickly add one more point here. If you see the household balance sheets, the net financial assets to GDP has also been moderating. So if we combine these two pieces together, the banks will have to do a bit of a hard work out there.
Sorry, what is that ratio you're saying? Net, what has been moderating?
The net financial assets to GDP has also been moderating over the last couple of years.
I see. But sorry, shouldn't that rise with more allocation into financial assets?
Absolutely, it should. But if you see also on the other hand, the households are borrowing. So the growth, as we all see, unsecured loan growth has been pretty strong compared to the GDP growth. Got
it. Now, just to clarify the last point, for how much, because this is a hot topic, right? In terms of whether money which was earlier going into this banks, deposits are going to equities, but specifically equities. Do you have any numbers? Have you looked at this over a period of time? What is that? Where is it at? And how has it changed over the years?
So we have that covered in our note for our investors, but there has been a significant shift. So if you see the stock of financial assets, the deposit share has been coming down. It has come off by a couple of percentage points. Even in the incremental savings on a yearly basis, the deposit share has been moderating. And it is actually well spread in other schemes also, apart from equity mutual funds. It's going to government savings schemes, it's going to insurance, it's going to even pension funds. So all of it put together is definitely posing more and more headwinds to the deposit growth for the banking system.
Okay, all right. Hi, Rahul. Good morning. Rahul, in FY24, we haven't seen any big divestment taking place in the government of India. But the hope is in the next couple of years that could very well be the case. And maybe there are a couple of large banking names which are in there, which could lead to some consolidation in the banking space. What's your view? How does it change the landscape?
Thanks, Nigel. Good question. If you see over the last couple of years, there has been a bit of a consolidation that's happening in terms of the market share, be it the deposits or credit. I guess your question is more around ownership. I'm also reading the same news article as you may have also read. The government also indicated that they are open to PSU reforms. So if the government walks down that path, clearly, the investors would look into it. We did talk about it in our note that passive flows could start, coming their way. But nevertheless, we'll wait and see how the government responds to that over the course of next few quarters.
Can we just elaborate a little more on this rise in unsecured lending? Because you do mention in your note as well that you are a bit concerned about the asset quality of many of these banks because of the rising consumer leverage that may pose, some threat to asset quality in the near to medium term. Is this largely for PSU banks? Are you concerned about private banks as well? And which are the pockets that could get affected?
Thanks, Sonia. Good question. So the unsecured loan growth has been all across. Of course, there are various pockets. There are different consumer cohorts. There are ticket size cohorts, etc., where the growth has happened. So it's actually quite broad-based. But the market share shift has been actually more towards the private banks and the non-bank finance companies. So in our opinion, and going back to the third quarter earnings also, you did see some of the lenders did talk about increase in credit costs and normalization of credit costs in unsecured loans. So we have been monitoring certain data points, be it the high frequency bounce rates, be it the consumer, be it the portfolio behavior in different buckets. All of it is pointing towards some deterioration happening in the space. And that is going to lead to some increase in credit costs or reversal of interest income as the slippages go up. So it's going to be all across the space is what our assessment is.
Right. So banks we've spoken about. What about NBFCs? I mean, if you are downgrading banks, NBFCs are lower down the line, generally in terms of preference. So what's the view there?
So we actually have been also having a neutral view on NBFCs as well. The way we see it is, and basis our investor interaction, if private banks are going to have a liquidity problem, NBFC, of course, as you rightly said, is going to go down, going to be lower down the pecking order. So they will also be facing some headwinds out there. So we prefer themes where the funding costs can be passed on to the borrowers. And that means commercial retail segment looks better than the consumer retail segment. And by commercial retail, we believe loans given to individual and smaller businesses, which is having a good cycle at this point of time, versus the consumer lending where we are seeing signs of over-leveraging. So NBFCs who are catering to those segments should be better off than the ones in the consumer lending space.
Okay. Can you just help us with how the valuations of banks are stacked up now? Is there any valuation headroom? I get your concern on the fundamentals, but how are we looking at it from a valuation perspective, both PSUs and private?
Yeah. Thanks, Sonia. Again, a good question. So I think valuations have been in the comfortable zone, by and large, at an aggregate level. But within that, if you unwrap the covers, you will find that certain banks have derated a lot more than the others, and therefore the averages have been pulled down. And that's where I think we are advising investors to remain selective, where the valuations are comfortable, the earnings are looking visible. I think investors would be better off there. So clearly, I think the valuation at an aggregate level looks okay, particularly for the private banks. But within that, you would need to pick and choose the names where the comfort would be there on earnings momentum as well as the downside protection and valuations. On the PSU banks, of course, we don't cover a whole lot, but the valuations have indeed moved higher. And now at these stages, we see the risk reward being balanced in that zone.
Okay, Rahul, good speaking to you. Thanks so much for joining in and sharing your thoughts on the banking as well as the financial space. Wishing you a good day ahead and looking forward to having a chat with you in the days to come.
Thank you, Nigel.